The next common type of business after a sole proprietorship, as I said, the sole proprietorship is the single most popular business model. Most businesses are single proprietorships, especially when you go into small towns. Go to downtown Waverly, and you're going to see a lot of independently owned businesses or sole proprietorship. The next type of business is a partnership. Partnership is owned by two or more people. There is no limit to how many partners a business can have. I've seen partnerships with more than 100 partners in them. When partnerships are created, the people are designated and their percent of ownership is created. So if you have 100 partners in a partnership and you're splitting up 100% of the profits, it might be that everybody's just getting 1% of the business. So you have to think about that. But it's two or more owners splitting some type of the proceeds. It is also relatively easy to start a partnership. It is a little bit more difficult than a sole proprietorship because with a sole proprietorship, as I said, an individual just needs to register some paperwork. With a partnership, you also have to have a legal agreement. And to begin a partnership, all of the parties involved have to create a legal document which indicates who brought in what to the company, how much cash did they donate, did they donate buildings, furniture, any other types of assets to the company, did they bring in trademarks or intellectual property such as copyrights, etc., the percentage that each owner is entitled to. So if it's going to be a 50-50 partnership or a 70-30, or you might have 4 partners that are splitting it evenly. So everything has to be identified in a document, processed through a lawyer. So it is just a little bit more time and money than starting a sole proprietorship. When a partnership, when one person decides to leave the partnership, that entire partnership needs to be dissolved and a new partnership would need to be created. So you cannot just sell out a partnership. You have to create an entirely new document and agreement with the partnership. Partnerships also have unlimited liability, where their individual assets, property, bank accounts, anything would be at risk in a lawsuit or a bankruptcy of the business. Okay. There are other types that you can file. Again, with a partnership also, you can create a limited liability corporation or an LLC with a little bit additional paperwork. Okay, so when thinking about the liability, this is when we're responsible for something by law. If I take out a car loan, I have a liability to pay the company that has sold me the car, or they're going to come and take the car back. A limited liability means it's limited to a fixed sum, usually their investment in the business. So if I contributed $50,000 to help start a new business, my contribution would be the only thing at risk in the case of a limited liability. With unlimited liability, there's no limit, and after the business has exhausted all of its funds, then the owners take full responsibility and have to pay in any instances. So if I have a sole proprietorship, I own my own business, and I took a loan out, but I'm not making enough money from customer sales, I personally am going to be responsible for that, and I'm going to have to dip into my own money in order to cover the liabilities of the business. Okay. We can have a limited partnership or a limited liability partnership. In a limited partnership, one partner takes unlimited liability and everybody else has limited liability. Generally, the partner with unlimited liability has the highest percentage of the profit. As I said, there's no rule that it has to be 50-50 if two people are opening a business. It could actually be 90-10. So it's really what you and your business partner or partners would come to an agreement of who should take profit. Sometimes it's based on investments. Sometimes it's based on interest. You might have heard the term silent partner. A silent partner is when somebody might invest in your business, so they have a monetary stake in the business, but they're not really interested in the day-to-day activities of running a business. They just want to support the business financially. In that case, they usually have a lower percent of the profit, usually just trying to recoup their investment back, and they don't really want to be involved in any of the day-to-day decisions. Okay, a limited liability company. So what I was talking about with that LLC, if you see LLC after names, I would recommend anyone who is interested in ever opening their own business, look into LLCs. I highly recommend that because that protects your own personal assets in the case of anything happening to your business. It just works like you have a sole proprietorship. You're just removing that unlimited liability disadvantage. And I'm not going to get into how taxes work with all of these businesses. I just want you to know these businesses exist. We're mostly going to be talking about corporations throughout this class, which are very large businesses that sell stock. Okay? So finishing up with our limited liability company, pros, they're protected from liability. They're easy startup. You don't pay additional taxes. The cons are you do have higher startup costs, and you might not be able to get, when it says hard to raise outside capital, that's how do you get people to infuse money into your business? If you're a sole proprietorship and you're not interested in sharing profits, you might not be able to convince anyone other than a bank to invest in your company or give you money to help you run your company. If you're a partnership sharing profits, you can get other people who are willing to become partners in your business to share income. There are higher startup costs, but it really isn't a lot of extra money. In the state of Iowa, it's an additional $80 to file the paperwork for a limited liability company versus just a sole proprietorship. So like I said, an extra $80 to protect your personal possessions from business liability, I think is completely worth the effort. So a corporation is a large business entity. They have a limited liability. They sell stock on the stock market. The Supreme Court decided in the early 2000s that a corporation is a legal person distinct from owners and a resident of a state, which means that corporations have the rights of people. A corporation can enter into a lawsuit. It can decide to sue someone, and it is considered an individual person is in a court of law. There have been Some, of course, questions about whether or not this is a good designation for corporations to have given the legal personhood. So there's some ethical qualms about whether or not this is a good or bad. We'll, of course, have a lot of discussions about ethical qualms and what is considered ethical and what isn't, and how that's a very individual designator. So right now we're just kind of defining a corporation. Examples of corporations would be Nike, Target, Walmart, Tesla, Ford, Volkswagen. So as I said, this is a large company. They sell stock. That is how they raise money. So when corporations sell stock into the stock market, they receive cash. So this is a way that they raise cash to do large projects. It's also a transfer of ownership. Every person who owns a share of stock in a corporation has a percentage of ownership. So if you have one share of stock and there are 100 total shares out in the marketplace, you have 1/100th ownership. Okay, so the percentage of ownership is based on the number of shares you own. Corporations have limited liability. Only the assets of the corporation are at stake in a bankruptcy or a lawsuit. They have unlimited life. So if a person dies, their shares get passed on to someone else or get sold by their relatives or their estate. So it's assumed that corporations will exist forever. Well, sole proprietorships and partnerships are assumed to only exist as long as the person that opened them is actively alive. Okay. Disadvantages of corporations is the separation of ownership and management, which creates an agency problem. So this is when the board of directors, the CEO, the directors of the corporation, and the shareholders are not agreeing on what the corporation should do. And we'll talk about some examples, but if you want to do some Googling, one would be to look at Target. So Target has made some decisions about what they will and won't carry in stores. They've made some decisions to remove DEI from their stores. They had some partnerships with self-owned businesses where they were bringing their products into the store and helping promote sole proprietorships of minorities. They have removed all of those products from their stores and canceled all of those partnerships. And their business has suffered drastically. There have been wide calls for boycotts of Target because of this, and now they're being sued by their shareholders. So because they've lost so much money and they've lost so much traffic, so it's something like 20% business loss over the last 6 months. Their shareholders are suing them because they said that the business underestimated how drastic these decisions were going to impact the bottom line. And since shareholders only make money if the company makes money, having a company lose 20% of their income really hurts shareholders. So this is a disconnect where it ended up where the decisions of management were not to the benefit of the company's shareholders. Okay. Another disadvantage is that the double taxation. So corporations are subject to what is called a double tax. The corporation must pay federal taxes on their profits, And then any dividends that they pass on to their shareholders are also taxed at the personal level. So their shareholders also end up paying tax on those dividends. If and dividend is a profit sharing term. So if a company makes a lot of money and they decide to share some out with their shareholders, which they have a right to do, they can issue cash to their shareholders, and that's called a dividend. If shareholders receive a dividend, they have to pay income taxes on those, and that's where the double taxation comes from. Okay, I'm going to stop this video here and we'll continue in the next one.